Hi, everybody. Welcome to the Debt-Free Life presentation. Today is October the 8th, 2020. It is 5:38 p.m. My name is Michael Scott Forehand. I'm with Symmetry Financial Group. I'm uh, direct to Janet and George Matthews here, my coaches, trainers, and mentors. And the focus of today is going to be debt-free life and some advanced funding strategies that we'll talk about towards the end. So what is debt-free life? It's a play on words. It's using a life insurance policy to help you get out of debt, and then ultimately using the debts that you have to help fund that program. So using the debts to pay off the debts. It's great. It's brilliant, and it works like a charm. And in the end, what should end up happening for you is you'll have one hell of a tax-free retirement that this is going to create for you. So if you're here, welcome. You're either an agent, broker underwriter like myself, or perhaps you're a client. Hopefully you get something out of this. If you don't, complain to whoever invited you here. It's not my fault. So moving on, when we first start this program, we ask two main questions. The first question is, are you 100% sure you're going to have a solid retirement? And I don't know anybody that can answer that truthfully. I know I couldn't. And the next question is, if we could show you a way to get out of debt in 9 years or less, including your mortgage, without spending any more money than you are spending today, would you be interested in finding out how to do that? And that's what this is all about. We're going to show you a way. We're not trying to create another debt for you. We're not trying to create another bill for you. All we're doing is trying to show you a way to more efficiently spend your money. So if you're like most Americans, this little pie chart describes you. You spend about 3% of your money in savings for the future. So let's look at that for a second. This is the average American. So you know how much money it takes you today to run your life. You know how much money you spend. Could you make it spending only 3%? And so obviously the answer is no, right? So there may be additional sources of income later in life, but the bottom line is we don't save enough money. We spend way too much money on taxes. 40 cents of every dollar you make is spent on taxes one way or the other. We spend way too much money on interest. This is definitely not what our founding fathers had in mind for our country. And finally, you work your tail off, you make good money, but in the end, you've got 23% of your dollar, 23 cents of every dollar is what you get to live on. That's to pay your bills and put food on the table. And if there's anything left over in the days of COVID, maybe pay your Netflix bill. The bottom line is this is not the way this is supposed to be done. This was never intended to work this way. This is just where we've gotten. And the reason why we've gotten that way is because we are taught, unfortunately, at a very early age, that it's okay to take on debt. And we're given more and more access to debt as we get older. You can't buy a $50,000 car when you're 18, but you can buy it when you're 40. So the idea is we're given more and more access to debt. It's thrown at us, and we're lemmings, some of us, and we do it. So I'm one of those people myself. So the idea here is that we want to change the way we spend money, spend it more efficiently, spend it smarter. So talked a minute ago about how much we do as Americans, what we spend money on. And the truth of the matter is, financially, we're all in pretty good shape. You make pretty good money. The average American is going to make $2 million in their lifetime. That's a lot of money. Certainly enough money that you can live your entire life on $2 million. The problem is we don't save enough, and that's at $60,000 at retirement. So if you're accustomed to making $60,000 a year, and all of a sudden you get to retire and you've only got $60,000 in retirement, there's a problem. And this is where most Americans get. And by the time you realize there's a problem, it's in most cases too late. The beauty of this program is that we can execute these programs for people up to 75 years old. And I've done one most recently. I did one on a 74-year-old, and it works like a charm. So it's just a matter of doing things the right way, spending money the right way, changing the way you spend money, and really amping up that retirement dollars that you're saving. So where you are right now, if you realize there's a problem, think there might be a problem, or absolutely know there's a problem, this is you. And maybe you've talked to somebody about debt consolidation. Maybe you've talked to somebody about credit reporting, repair, and all that stuff. And they're all going to tell you everything you see on the right side of your screen. work harder, spend less money, save more money, refinance, consolidate, of all those things. I ate ramen noodles and tuna fish when I was in college. I have no desire to go back to that being my staple food source. So all those things when we get older, those aren't really solutions. There might be band-aids at best. That debt snowball is the only thing that we do like, that we do use, but we don't do what most people consider to be debt snowballing. That's actually debt stacking, which it does work. It does eliminate debt, but it doesn't work as fast or as efficiently as a true debt snowball will. And that's part of the program that we do here is true debt snowballing. So if I could show you, or we could show you a better way to do this, a better way to earn money, a better way to save money, a better way to spend money without you having to spend any more than you're already spending right now, would you want to do it? If we could show you a way to eliminate your debt in 9 years or less without spending any additional money, would you want to do it? And of course you would. And there is a better way. And the better way is what we're talking about here today. This is debt-free life. This is a program that was created by Symmetry Financial Group in 2019. The concepts are not necessarily new. They've been around for 100 years or more, but this particular program is new in 2019. And the previous iterations of these concepts that came before us have all failed at some point or another. And what we did when we came up with Debt Free Life is we created an environment where we took into consideration those reasons why those programs failed. And we put stopgaps in place so that they won't fail. So this program won't fail as long as you follow the plan. So what our goal is to move you from where you are right now at the left side of the screen that you see there. 3% savings, 34% interest, 40% taxes, 23% in your lifestyle money. And we want to move you over to the much more healthy side where you're saving an increased 500% into your savings, right? And we're not, again, not spending any more money than you're already spending. We're going to decrease the taxes you pay by 25%. That's huge. We're going to decrease the amount of interest you pay from 34% down to 22%. That's a decrease of 35% in interest. So when we look at these savings and we look at the increased amount that we're saving and how much money we're saving on taxes, insurance, you're still making the same amount of money. You're still spending the same amount of money, but now things are significantly different. Now we're able to spend even more on our lifestyle. So what we're doing here is we're creating an environment where you don't have to worry about whether or not you have enough money to pay your Netflix bill. You don't have to worry about if you can afford to go out and eat once a week. Maybe it's twice a week. The money issues, we're going to make them go away or help them make them go away for you. And the idea here, going from a 23%, which you have every month, up to 33%, which you have every month to be able to spend on lifestyle. That's a 43% increase, folks. That's huge. So think of it like this. If you spend your money the way you make it right now, and you get to the point where you've got $1,000 currently left over every month in your checking account, simply by spending the money differently, you're going to get up to $1,430. That $430 makes a lot of difference for a lot of people. Okay? So let's move on. So what we're going to do and how we do it, we're going to reduce the amount of interest you pay. Simple. I just showed you that. We're going to eliminate your debt in 9 years or less. Really, what I find is that number is a little, it's incorrect. 9 years or less is probably the standard, but it's actually a range. So what I'm seeing is we're going to get you out of debt in 15 to 23 years early. 15 to 27 years early. I've seen somebody do one of these programs. They were out of debt in 2.3 years. Okay. So it's not 9 years or less is good, but I think 15 to 27 years early sounds better. So reduce your taxes. Nobody likes to pay taxes. Everybody knows taxes are going up. Social Security is going to be default by 2030 unless they fix it. Where the federal government is spending money left and right like it's going out of style with this COVID stuff, trying to rescue all of us. I get it. I understand. But at the end of the day, we started with $22 trillion in debt, and now we're $26 trillion in debt. It's not going away, folks. And all we're doing is we're spending our children's and our grandchildren's efforts to get us out of debt. I'm over 50, so I'm happy. Thank you very much, youngsters, for making so I can still retire. But at the bottom, at the end of the line, there's still going to be a huge increase in taxes. And the beautiful thing about this program is it's tax exempt. We're going to improve your cash flow. That's what does that mean? Which we already talked about. Average of 43% increase in cash flow, and allow you to retire with a tax favored income. And to be honest with you, I don't know any type of income that's more tax favored than a tax exempt income. Okay, so how do we do that? Well, the first thing we do is we fix. Remember those other programs I spoke about earlier? I told you this isn't a new concept. It's been around for a while. Other people have tried it. They use different vehicles. You'll hear indexed universal life policies are some vehicles that people have used in the past. There's pros and cons for every program. Problem with that program is if you don't have regular gains in the stock market and you hit a stretch of losses, those IULs do not perform. You've had other people talk about using a home equity line of credits. And my first knee-jerk reaction to that is, why in the world would I pay off a credit card by sacrificing equity in my house? Okay, it doesn't make sense to me, and it's not necessary. So there's lots of options that have been out there before. There's lots of reasons why they fail. And like I said, we figured out the reason why they failed and build in stop gaps. And the number one reason why all those programs in the past have failed is because they don't plan for the emergency. They don't plan for that what if. So our system, our solution here builds into this whole program an emergency fund that's hidden. It's there. You can't see it. You don't want you to touch it. It is actually, if you do touch it, you are affecting the principle of the program. We don't want you to touch that. But we build in a 20% reserve. It's there. It grows over time, and you're good to go with this program. If that transmission drops, you need to replace it, or whatever the case, whatever the emergency is that you have. So when you look at these programs in comparison to other types of retirement vehicles, all right, so that would be a 401k, a 403b, a Roth, things like that. They all perform fairly well. They do mostly what they're supposed to do, but if you actually graph it out and look at how one of these programs is going to work in a tax-free environment versus something that's a tax-deferred environment like your 401k, then or the Roth, which is the taxed environment, then you're going to see without a doubt at the end of the day, all that matters is at a specific point in time, how much money do you have? And so what we're looking at here is a 28-year run. And in 28 years, investing the same amount of money with all three of these options having the same kind of interest, 7% interest is what the tax deferred and the taxed account are going to pay. And all three of these accounts paying the same amount of interest when you start pulling money, with the exception of our tax-free account. Hands down, it's a no-brainer. The tax-free result solution that we have, debt-free life, outperforms the other two without a doubt. And I would say, the reality is when there's big dips in the market, like what's getting ready to come, then those other programs are going to significantly underperform as well, because not only are they going to be affected by the big dip, they're also going to have to make up the difference just to get back to even. And while those accounts are coming back over the next 2, 3, 4 years, our account's continuing to grow. So this is the hare versus the rabbit discussion. I'm going to stick with, the rabbit versus the turtle discussion. I'd rather stick with the turtle, because in this case, it's a no-brainer. I don't have to think about it. I don't have to manage it. I don't have to pay any fees for it. It's just rolling. All right, next. Debt-free life works in 3 phases. Most Americans have way too much debt. The numbers are staggering, the amount of debt this country carries, and it doesn't need to be that way. So the first and primary goal of a debt-free life program, it's in the name, is to become debt-free. So that's that maximization phase. So what we're going to do is we're going to take the money you're spending, we're going to put it into a situation where you're able to spend it over and over and over again. We'll talk about that in a minute. And we're going to eliminate your debt using what is true debt snowballing. So once we eliminate a debt, we're going to use the money you were paying to service that debt to start paying off the next debt, and do it over and over and over and over again until all your debts are gone. Once all your debts are gone, you're going to enter that accumulation phase. And what that is, it's kind of it's open. It's open to you. You decide how long you want to do it. So once the program's done and you're out of debt, you can use it and continue to fund it and make a huge retirement for yourself. You can pull back and start enjoying some of your cash as you need to. That's fine too. But the bottom line is, it's up to you. But the accumulation phase is designed for you to build that large amount of retirement income until you get to the distribution phase. The distribution phase, that's the end game. That's where we're all headed. If you've got a 401k and you have questions, don't have any questions. Know the answers. Put it into a debt-free life campaign. You'll be fine. The distribution phase, that's when you can take that emergency trip to Tahiti. You can buy that emergency jet ski. Those things that you've been, putting off or saving for, that's fine. Between maximization and accumulation, we know things will happen. Life happens. You might need a new roof. You might need to buy a new car because your last one died. Whatever. It's okay. The program is fluid and we can always add in stuff as we need to. And the truth be told, the program actually works better when we add additional debts into the mix. The last one I did, I saw just a simple a $6,000 purchase of a water softener for a house between the time that we made application for the program and the time that we put the program in place. That simple $6,000 purchase, and this doesn't make any sense, this is just the way the numbers work, actually made that client get out of debt 2.4 years faster and created $80,000 of additional retirement at the distribution phase. So don't be afraid to spend the money in the program. It's there for a reason, but be cognizant that you are the banker, you are the owner of the program. So pay yourself back and charge yourself an appropriate interest rate, which for me is 0. Okay. Next, as I mentioned earlier, this is not a new program. Symmetry's debt-free life is new, but the concept is not. The concept has been used by all the people you see up there on your screen: Walt Disney, Doris Christopher, Ray Kroc, even Warren Buffett. And the whole idea behind this is, unfortunately, previously, you had to have a whole lot of money to be able to play in this arena previously. Most of us didn't have it available to us. And the programs weren't really streamlined to the way that they are now to afford to us the guaranteed results that we have at this point. So concept's not new. Debt-free life is new, and debt-free life is an improvement on everybody that's come before us because they all failed for some reason, and we've eliminated those failure points for you. Next, we already talked about this. How does it work? We're simply going to teach you how to spend money more efficiently, and we're going to put you in a situation and put you on a plan, put you on a track that you can follow or not. If you follow the plan, the result that we tell you is going to happen will happen. If you don't follow the plan, who knows? Maybe it works better than the plan. Unlikely, unless you're adding an additional debt. Or worse, it's up to you. Once you take the program and start the program, you're really in the driver's seat. Okay? What is your goal? Are you trying to leave a legacy? Well, these programs, if you structure them correctly, this can create not just a legacy for your immediate family, your children, but certainly generational wealth for your grandchildren and your great-grandchildren. And if you do it correctly, you're going to do it in a tax-free manner for everybody. But that's up to you. That's where you have to make the right decisions. Talk to your people, that whoever brought you to this presentation, work with your agents, brokers, and underwriters, and just be honest and open. If you do that, then you'll have a good success here. So when this slide was made, we were right at the beginning stages back in 2019, and those were the first couple families that we were able to help. The reality is that those numbers are nothing compared to what we see. The average debt that I'm seeing is well over $400,000 for the clients that I work with. So this is not. So if you think you have $400,000 in the debt, don't worry about it. You're in good shape. This will still work for you. As long as you're making your debt service, as long as you're paying all your bills. The only people this program really doesn't work for are people that are over 75 years old, or people that really don't have any business trying to execute one of these programs, because really their choice should be bankruptcy. And so that's such a small portion of the population that I would say, I would bet 95, maybe 99% of the people out there that want to do something like this would be eligible. So now let's take a look at the differences between debt-free life, how you spend money, and how you spend money with the Debt-Free Life campaign. So this is the way you currently spend money. You make $1, it goes into your checking account, goes into your bank, your Wells Fargo bank, whatever. That bank makes money with your money every night. The average dollar you put into your current bank account, whoever you bank with, that bank is going to lend out 7 times. And in that 7 times of lending it out, they're going to make money every day, and they're not going to pay you a dime. They're taking your money and they're making money with your money. And I've heard some of them say, and this, talk about audacity, I've heard some of them say things like, you know what? You've got over $2,500 in our account. We're not going to charge you to keep your money here. So when I hear stuff like that, it burns me up. And it's like, okay, no problem. Tell you what, I'm just not going to keep my money there. And that's what Debt-Free Life allows you to do. In the end, when it comes time to pay off your debt, you go into your bill pay system, or however you write the paper check, it doesn't really matter. You send the money to whoever you owe the debt to. That money becomes their money. And now all of a sudden, what happened? The net result is your debt is paid off, but your money's gone. And if you're super nice and you're super sweet and you ask real nice if you can have your money back, the answer is going to be no, right? So the whole idea here is that we're using our money only one time. And the only body that's putting our money to work for them is the bank. So Debt-Free Life says there's a better way. So here's the better way. You still make the same money. You don't have to go out and get another job. You don't have to double up. You don't have to get a part-time, whatever. You don't have to do anything different than what you're doing right now. You still make the same money. You still deposit your money into your checking account. That doesn't change. It goes into your Wells Fargo, Bank of America, USA, whoever you bank with. It doesn't matter. Here's where we change the gear. In this scenario, and this is how Debt-Free Life works, I'm going to make a payment to my life insurance policy. And that life insurance policy is going to be a special kind of life insurance policy called a participating whole life policy. About 21% of whatever I'm paying to my life insurance policy is going to be paid towards that whole life policy. And that 21%, some of that is going to be put into the cash value of the account as well. So not all of it's going to pay for life insurance. The next thing we do with that single payment that we've made out of our checking account to the life insurance carrier that we have our contract with, we're going to pay for a term life rider. Okay. So that term life rider expands the total amount of life insurance coverage associated with that whole life policy. This is a critical part to what we do here. And the reason why, and this goes back to IRS tax code 7702, the IRS tax code says any money derived from a life insurance policy is tax exempt. It also says that loans are tax exempt. So at this point, what we're doing here is we're creating an umbrella with that life insurance policy that's going to allow us to grow the cash underneath that term life umbrella so that we don't cross the line with the IRS. This will happen if you're not careful. We do not want to cross the line where that particular program has more cash value than life insurance value. Because when that happens, this program is no longer life insurance. And the IRS says, wait a minute, that's an endowment contract. And an endowment contract is 100% taxable. Even if you paid the money in beforehand, you're paying tax on everything again when you pull it out. Okay. So the idea here, we don't want it to MEC. It's called MECing, MEC, modified endowment contract. So the reason that's why we put that big term rider on there. That term rider usually costs somewhere between 5 and 11% of whatever your premium payment is. So next, what happens next? That last part of that payment that we're making, which is roughly 62 to 68% of that premium payment, that's going to buy a paid up edition. So what is a paid up edition? There are 4 kinds of life insurance: term life, whole life, universal life, straight life. All straight life is a death benefit policy. That's it. All a paid up edition is a death benefit policy with one kicker. Once you pay for it, you never have to pay for it again. There's no fee that you have to pay to maintain it. It's never going to lose value. It's going to be worth exactly what you paid for today, tomorrow, next month, next year, next decade, as long as you're alive. And when you pass, it's going to pay out exactly how much you paid for it. Why is that an issue? Well, the banks look at that as what's called a tier one investment, meaning that that's the most safe type of investment that you can have. It's an investment that has permanent value until the person dies. It's an investment that you don't have to pay any maintenance fees on. And that's why Wells Fargo, for example, has 41% of their assets structured in life insurance policies that they've purchased because they have permanent value. So that's where the money goes when you first start the program. You make your payment gets sent to the carrier, gets split up three ways. Then what happens? Well, where the bank was making money with your money all the time, now you're making money with your money because you've just moved up your money into your bank, into your DFL bank. So how does your money make money with your money? Well, the carriers, who are the largest institutional investors on the planet, the carriers take the money that you're putting into this program and they invest it. And they're earning anywhere from 12 to 20% with your money. And they're nice enough to pay you 4. They're going to pay you a guaranteed 4%. And that number that they're paying that 4% on is the combination of how much money do you have in your paid up edition and how much money do you have as the cash value of your whole life. So you're getting paid a guaranteed 4%. In addition, remember I said this is a participating whole life, and the carriers we use are mutual carriers. So that means they are able to provide a dividend. So as a owner of a policy with one of these carriers, you get paid not only the 4% guaranteed interest, but you also get paid a dividend. So Einstein said it, there's nothing more powerful than the effect of compound interest. All of these carriers offer compound interest. And one of the carriers that we use, one of my favorites, they actually offer monthly compounding, which is critical to this. So where are we at in this program? So you've paid your life insurance premium. Life insurance premium paid your whole life and your term life policy costs and bought you additional life insurance in the form of a paid up edition. After you do this over and over for a while, that paid up edition bank, because that's what it is, grows to a certain value. And now all of a sudden, the amount that you owe is equal to the amount that you have in your bank. And then you pull the money out of your bank and pay off that debt. Now, there's a critical part here. We are not taking principal. We're not taking the cash value out of the program. All we're doing is taking a loan. That's what makes this program tax exempt. So let's fast forward. I'm to the point now where I've got my car down to $2,000 and I've got $2,500 in my paid up editions bank. So I'm going to take out $2,000 and I'm going to deposit it into my checking account. So that's a carrier loan. It's not my cash. My cash is still in my bank making money for me. All I'm doing is taking a loan against that cash. Then I'm telling my bank account, bill pay, write a check, whatever, to pay that debt. And then the debtor, the company that owns my car, receives my last payment of $2,000, pays that off. And now that money becomes their money. That money's gone forever. Whose money is it? It's the carrier's money. My money is still in my account, working and earning permanently. I have captured that money and sequestered that money permanently. If I had gone the other way, that money be gone forever. Now I have nothing to show for it. Now I've still got that $2,000 sitting up in my DFL bank, earning the 4% plus a guaranteed interest plus the dividend. So let's look at an example. How does this work? So this is a family that I worked with back in last October. They have a lot of debt, a lot of student debt. They've got 2 houses. This was they were both previously married. One of the individuals is a 1099 employee, so he's got some IRS tax issues and some Virginia state tax issues that they're working on. So there's a lot of debts here. One thing I want to bring to point here: these programs work for everybody. The number of debts you have, plural, affects how quickly the program will work for you. That's the effect of the debt snowball. So for example, if you have 2 people that have $100,000 in debt each, the person with $100,000 in debt on just a mortgage, their program is not going to work as quickly as the person with $100,000 in debt because of 7 credit cards. Okay. So the numbers of debts affects the efficiency of the program, not the amount of debt. The amount of debt's irrelevant. Okay. Well, not to you, Scott, right? Yeah, I heard all you talking. All right, so this is their program, 40 years. They thought they owed $584,000, which was true if they could write a check for that. The truth is, once you factor in the interest, their true debt is 767. And because of the nature of having those student loans, which are vicious, by the way, they were going to be in debt for 40 years before they got this thing paid off. So all we did was repurpose the money, figure out where they were overspending on some things. They, had a credit card where there was a $300 minimum payment and they were paying six because they thought they were being prudent and trying to pay it off fast. All we did was repurpose that money. And if they had stayed on the program that they were currently on, they'd be out of debt in 40 years. But with our program, repurposing where they were overspending, 7.8 years. This is not abnormal, folks. This is the norm. It's not surprising to me. But more importantly, we saved them $70,000 in interest. So if I walked up to you and said, hey, I'm going to help you pay off your debt and I'm going to give you $70,000 in your pocket that you're not going to have 40 years from now, would you want to do that program? Of course you would. But realistically, when the decision to do this program or not to do this program came up, it's really a no-brainer. What would it have cost them not to do this program? And here you go. The end result is they would have paid $182,000 in interest, taking them 40 years to pay it off. We got them out of debt 7.8 years, saved $70,000 in interest. But more importantly, look at that. Through operating this program for 40 years, and it's possible they could. The person this is written on is only 36 years old, but they don't need to. But if they did, then in their old plan, they would be at zero. They would have nothing extra to show for it, no debt, other than the equity in their homes. In this case, doing this program without spending any more money than they're already spending, they became 4.8 million positive. That's how much they had left over in their accounts at the end of 40 years. That does not include the equity they have in their homes. That does not include the paid up life insurance they have, which is huge. So when you take the life insurance and that liquidity in combination, it's $5.9 million. That's huge, simply by changing the way they spend money. So this is how it worked for them. Each one of those yellow bars is a year of the program in which we paid something off. And one of the things I want to look at, you've heard me do, if you've been here before, you've seen mortgage chunking before. In this scenario, they would have mortgage chunked $120,000 in year 6, and it would not have taken them this long to get out of this debt. It would have increased this by about 6 months, maybe 8 months. More importantly, remember I told you they wanted to retire at 73, or they wanted to retire in 40 years. The reality is he wanted to retire at 70, 3.8 million. That's a lot of money. I could probably retire with $3.8 million in the bank. I think most people could. But the reality is, if you wanted to, we could have him retired at 50. $843,000 in the bank. That's enough money to have a really, really strong return annually. That's probably $50,000 or $60,000 a year coming in every year. How much is it? 842 to 969 with 32,000 in. 872. That's just under $100,000 a year income every year for the rest of his life. And at that point, he could stop paying into the program, and the program would be self-fulfilling. And moreover, there's $2.3 million of life insurance there. Nuts. Never has to pay for it, right? So what if you're not somebody that has a large debt? What if you're not somebody that owns a mortgage, but you just have credit cards and maybe medical bills or whatever? Well, here's a good example for a student, 23 years old, master's student, Caltech, studying oceanography. Pretty simple. Got a lot of debt at 23 years old, has $177,000 combined debt. That's interest plus the principal. It's going to take her 40 years to pay this off. She works as a waitress. This program was a $350 a month program. Just looking at the places where we're repurposing the money that she's spending. Pretty straightforward. 9.7 years. So, did we get her out of debt in 9 years or less? No. Did we get her out of debt in 15 to 27 years early? Absolutely. In this case, it was actually 31 years early. Okay. So not rocket science, pretty straightforward, using the debt snowball technique, looking at which debts we're going to pay off first, not necessarily in order of interest. That's the misconception about debt snowballing. It's not about the interest rate. It's part of it, but the equation really comes into play. It's about the snowball. How quickly can I get the snowball the largest? Because that allows me to pay off my debt the fastest. For her, 40 years, $91,000 in interest. We saved 64,000, got her out of debt in 9.7 years. And in 40 years, she'll have 603,000. So that means at age 63, without spending any more money than she's spending right now, she'll have over $600,000 liquid in her account. Plus a paid up life insurance is pretty heavy. So at 56 though, this is when I retired her. So at 56 years old, she never has to work a day in her life. She's got $431,000 in the account in the program. It's earning $22,000 a year, which is the equivalent of $36,000 if you're taxed at the current rates. So basically, she's been given a $36,000 a year pension for the rest of her life. And moreover, if that's all she takes is the 36,000, this number is never going to drop. It's going to continue to grow. That death benefit is paid up at that point. She's got a $685,000 policy to leave to her family. There's her legacy. There's her generational wealth for $350 a month. The program's amazing, folks. Pretty straightforward. So that's the end of this little presentation. Let me see. I've got 2 questions before I show the next part. Why would an insurance company do this? What's in it for them? It sounds too good to be true. So why would an insurance company do this? Because it gives them more money to invest, because they get to make more money. Pretty simple. If they're making 16 to 20% with your money, but they're only paying you 4, their delta is 12%. If I could get people to give me money and I would be able to make 12% with that money, I would do this all day long if I could do this, right? So how can you cross the line and turn it into a mech? How? By putting too much money into it too fast, and you do not want that to happen. The idea is you want to stay away from meching. Who can sell this program? You're a new agent. Hello, David. Welcome to the party. I know you sent that privately. Sorry, buddy. Didn't mean to throw you under the bus. So any agent with a life and health license or broker with a life and health license can offer this program. You will need errors and omissions insurance. You will need to take the additional training. You will need to get certified, and you will need to buy the software. Last time I saw the software was about $5,000. All right. There you go. All right. So now let's show you the new. Before I go, we're really on time here, Tom. Before I go any further, does anybody else have any questions about anything before I move on? Right on. All right, so here's your little secret stuff for the day. How do you fund a DFL? How do you fund a debt-free life program? So one of the things that we look at is we're looking at repurposing inefficiently spent money. So when you have that credit card that the minimum payment is $300, but you're paying $600, that's inefficiently spent money. When you're putting money into your 401k, 10% because you want to catch up, but they're only matching you 3%, that's 7% inefficiently spent money. When you have that student loan that's in deferment and you're still making payments on it, that's inefficiently spent money. All right. So there's lots of places you can find inefficiently spent money. Let's say you got talked into some really bad life insurance policy from one of the the corner store carriers that have offices on the corners, and you're not getting the living benefits and all those other things. That's inefficiently spent money. So there's lots of places to find this. But here's one that some people maybe know about. This is something I've been doing, and it works pretty well. So if you're a homeowner, then you have a mortgage, and your mortgage is composed of 4 parts. It's a principal, interest, taxes, insurance, payment. So PITI. Okay. So here's an example of a mortgage. I just ran this today. This is real. This individual has a mortgage payment that's just under $1,200 principal and interest. But because of the taxes and because of the escrow for the insurance, his mortgage payment is about $1,700. All right. So this is real. So that means over the course of a year, he's paying $478 a month on just making his mortgage payments times 12. So he's paying $5,736 to his lender. And that lender is putting that money in an escrow account and earning interest with it. And then at different parts of the times of the year, that lender is pulling that money out and making those payments to your local municipality for your property taxes and to your insurance carrier for your homeowner's insurance. This sounds a whole lot to me like having extra money taken out of your paycheck so that you can get back that refund from Uncle Sam. Why in the world would you give somebody money to make money with your money when you could be making money with your money? So this is the concept. So if I have $5,736 going into my account a year, and I'm earning interest on that per year, then that's basically in the first year $229. If I'm walking down the street and I see $229 laying in the gutter and there's nobody else around and I can't figure out who that money belongs to, that money is going into my pocket and my wife and I are going out to have a nice dinner. Okay. So the idea here is, why, if you had an opportunity to make $229, why wouldn't you? Right. But take this a step further. This person spends $5,736 a year, every year on his mortgage, right? So that means if you look at how much interest you're going to earn versus how much interest it's going to cost in the first year to do this program, to put that 5736 up into your DFL program and then take out the loan when you need it to pay off those debts, you're going to lose $44 in the year. That's making the 229 minus the interest you're going to pay, right? And the second year, it's going to be even more. So does it make sense to do this? In the third year, you're down to zero. So what's happening here is the effective compound interest. It's kicked in. One other thing. Remember I said these programs are participating whole life? We have no idea what kind of dividend they're going to pay, other than we know that the carriers we use have paid a dividend every year they've ever been in business. Okay? So what happens? I didn't do all the math until we got to the end because the end's exciting. So look at that growth. All that is adding in 5736 every year. That's your running total, plus the 4% gain. Remember, taking a loan does not affect the interest. Taking a loan affects the dividend. It does not affect the interest. Boom. In year 12, you'll have $89,000 in that account. And you'll be making $34.47 that year just in the interest on that amount of money that you would have spent and had gone forever. Then it goes up to $38.15 and so on. So the point that I'm making here is you're going to be paying taxes and interest on your home for as long as you own it, not just when you have a mortgage, but forever. And where this goes is in year 16 or 17, maybe 18, the interest, just the interest that you're earning on what you've been paying into this thing year after year is paying your taxes and interest for you. Not to mention, you've got $120,000 liquid sitting in your account because you never take out your money. You only take loans. So you got a mortgage. You want to give yourself $120,000 extra in retirement. Stop letting your lender take that money and put it into an escrow account and use it for their benefit. Stop it. Just pay your principal and interest payment directly to the lender, and you pay your own taxes and insurance and put it up into your own escrow account, which is your debt-free life program. So all those folks that are out there that have had trouble finding money for people, every one of the requests that I get is a mortgage protection request. Every one of these people has a mortgage. And most of these people don't know that they don't have to escrow taxes and insurance. They just do it because the lender makes it easy for them. Why does the lender make it easy for them? Because the lender's getting to capture $3,400 in interest because they're making more money than that. So there you go. I'm going to stop sharing. Did anybody have an aha moment right there? You should have. All right. So now Mind blown, Lisa Bijol. Welcome. All right. So anybody wants to ask a question or have a discussion, please unmute and shoot. Hey, Pat. How you doing, buddy? I haven't seen you in a while.
Hey, good to see you, Scott.
Good to see you too.
I do have a quick question. Right now, is there something going on where people could put their 401ks possibly in it?
Yeah, the CARES Act allows you to take, if you have a COVID-related emergency, which, reading between the lines, they want you to declare that you have a COVID-related emergency. When you open that up, they don't have anybody to go back and check to see if you had a COVID-related emergency. So raising your hand and say, I have a COVID-related emergency, probably good to go. Caveat, I'm not a CPA, talk to your CPA. Okay. But the CARES Act allows you to take money now. So you can, so even if, you can't take money out of a 401k normally, unless you're 59 and a half or ready to retire, you can take it out now without penalty. Okay. And you can take loans. In theory, you should be able to take loans at 0% as well. And you have 3 years to pay it back if you take a loan.
Or any portion of it out.
Say again?
You could take it all or any portion of it out if you wanted to.
Talk to your CPA. If you take it all and close it out, you're going to owe. Okay. But if you take it all and leave $1 in there, you have 3 years. If you took it as a loan, you have 3 years to pay it back. And then otherwise, the amount you take, it's up to you. I do have a client that just drained 3 of her 401ks and put all that money into her DFL program on day one. She did this with the understanding that she's probably going to have about a $1,200, $1,500 tax bill. But on day 2, she took that money right back out and paid off all of her debt except for her mortgage. Okay. So what did that do for her? That $1,200 in taxes she's going to have the one time does not come anywhere. She's going to make up in interest in 3 years what she paid in taxes this year. And then, the 15 years beyond that, because once you put the money in there, it's growing and growing and growing. Once you put the money in there, you're good to go. Beyond that, how much did she save in interest? She saved a lot more than $1,200 on all those debts she just paid off. And more importantly, what did that do for her snowball? So we built that program so she could put it up to $70,000 a year. So that snowball is rolling, and she's in her 3rd month now. She's actually getting ready to start hyper funding it because she just got a raise. Good to go.
Okay. Thank you, Scott.
Yeah, man.
So Scott, dovetailing on what Pat's question is, because I have a client that this might actually apply for. If they're under 59 and a half, there's no penalty if it's a COVID related problem, which means maybe someone in the family got laid off and they don't have an income and they need to access it. If they pay the loan back within 3 years, do they have to pay taxes on it? Okay. So what would stop somebody from, in that situation?
You got it.
What would stop somebody from taking $100,000 out of their $120,000 401k, loading it into a DFL, and then using the DFL to pay the loan back over the course of 3 years?
You got it.
Okay.
Yep.
It just looked too easy. I wanted to make sure I understood it. That's pretty easy.
That's it. Thinking outside the box.
Okay.
Now you do have to season the money.
You have to what?
You have to season the money.
With any particular spice you prefer?
Because all those things. Well, not paying it back. Oh, no. I mean, as long as you've got the income to show it, you can take it. No, you're fine. Never mind. It's your money. Never mind. Disregard that.
What's season the money? Is that like salt and pepper or
no?
What?
There are solutions where you can take money and put it into one program versus another. But there's many of those cases, especially the financial products. There's going to be a question about where did the money come,
Gotcha.
And if the money came from a loan from another program, that's not going to pass suitability. So the way you do it is you season the money. I put $30,000 into my account, but in between now and 2 months from now, when I execute that program, I've made $30,000. So that's, my money is now seasoned, because I can say, no, I'm not using the $30,000 I borrowed. I'm using the $30,000 I made. Okay. Right. And that's how you can, that's seasoning the money.
Okay. Gotcha. Scott, thank you. And by the way, I love this new twist, and it's got my mind going with all the clients that I've already talked to.
Yeah.
Especially the one that I just read a DFL on that I now would go back to and probably double the size of the DFL. How would you pitch it? How would you broach the subject with a client that you say you've had a client for a year now? or 2 years, a mortgage protection client for 2 years, and you're going back to me like, I want to show you something. How would you break the ice with them?
Hey, Tom, it's great to see you again. I know it's been a year since we talked, but I want to talk to you about a whole new program that just came out. And we're doing some really exciting things. Let's have a conversation on Tuesday about this. Okay. You're going
Okay.
to like this. I'm going to help you with your retirement. Come
Okay.
in, do the appointment. All right, Tom, look, here's the deal. I know you have a mortgage because that's why I originally talked to you. And we put the mortgage protection in place, and you're covered now. And that's great. And I'm happy for you and your family and that you guys are safe. But let me ask you this. Then you go right into it. Do you think you're going to have a perfect retirement? Do you have any doubt?
No, I'm doubtful.
Right. And do you think if we can use a solution that just came out that'll help you, and then you're just going to launch into that, and then you say, all right, so look, you've got mortgage protection in place. That's great. I'm going to show you mortgage elimination.
Okay. But I mean, actually, sorry, maybe I didn't state the question correctly. I like that. I was talking specifically about the escrow, about redirecting the escrow.
Okay.
How do you explain that
just
to
talk
somebody?
to that. Say you pay principal, interest, taxes, insurance, right? How much is your lender giving you for the money they're making with your taxes and insurance escrow?
What do you mean?
Well, they're taking your money, they're put into an account, they're earning money with your account, and then they're paying, they're paying your escrow payments for you.
No, they can't do that.
How much are they paying you for that, for the use of your money?
They're not earning any money on it. They'd have to show that.
Okay. So what would I say if I could show you a way that you could earn money on that and still do it?
I'm listening.
Okay. So why don't we do this? Call your lender, tell them you don't want them to escrow anymore. Call your local taxation group, whoever that is, and say, send me the bills from now on, and we're going to put this money up into your program.
Okay.
Now, one more caveat about this: you cannot use taxes and insurance repurposed escrow payments. You can't use them as the core cost for the policy, because remember, 32% is going to get eaten up in that term and whole life. And also, when you're running these things, you have to make sure you instruct your folks, do not, under any circumstance, use that money for anything other than your taxes and your escrow payment. Okay?
Because otherwise they're going to be cut short.
Right. So you do not want to create a problem for your folks, but you want to create.
In the scenario that you just said, and I'm sorry to cut you off, would it, and this is going to get a little bit techie, and I apologize ahead of time. If we're breaking it down in a 68-32% split, would you say that escrow payment that you flashed up earlier, that would constitute the 68%?
No.
Okay.
So this is where, when you're writing the actual policy, I don't wait. With every one of these I ever do, I am always maximizing the term. I don't care. All right, because I want there to be options for these people.
Gotcha.
Okay. So, when I'm running the mutual trust piece, I'm putting in $1 million term policy, and it's going to bring it down to whatever level the maximum term policy is for whatever the price range is. Okay. And that's going to give me that room. And so, it may be one of those things where we say, all right, you're doing well now. Let's talk about your debts. And maybe you end up starting another bank. I don't know. But the whole point is you have to be careful. You cannot use that money for any portion of the base policy.
So you did not answer my question the way I wanted it. The way I want to understand it. So okay. Let me go back. Okay. $1 million term. Okay. Minimal whole life face amount, whatever we need to do that. But none of the escrow money goes to pay for the term or the whole life. It only goes into the PUA.
Right.
So it's not just and historically that's been about a third roughly has gone into the term and the whole life.
Okay.
So what we're saying is, we go back to that example that you had, which was $5,000 a year, $5,700 a year.
5736.
So there need to be they'd be spending about $200 a month on the life insurance, and then the rest of it would go into the escrow. Would represent the escrow going into the PUA. Do I understand it correctly?
Every case is a little different,
but generally that's
the only thing you should be using these numbers for is in the PUA that you've got. When you're running these illustrations, you've got a stipulated PUA bank and you've got a maximum PUA bank. So if they're going to be dumping in 5736, for their escrow, you need to make sure the difference, the delta between the stipulated and the maximum is at least 5736. And even
Okay.
then, that's not enough. Okay. Because there's the snowball, which is independent of the escrow piece. The snowball is going to hit too. So you need to be able to capture some of that snowball. I always
Okay.
look and I try to capture all the snowball if I can. That's why I always maximize the term.
Okay. Final carrier question for you. I'm working with one of my agents, and they've got 2 people, a married couple, and it's not going to be 6 years until they need to open up a second bank.
Okay.
They're going to insure the wife first because she's super preferred on the risk assessment.
Insure the least healthy person.
Okay, explain.
The least health. Well, let me pass that for a second. What is the purpose of the program? If the purpose is to get debt free, then you insure the least healthy person. If the purpose of the program is debt free plus death benefit, then you insure the healthiest person.
They're after debt free plus early retirement. And
okay, then you want to insure the least healthy person as long as they'll get approved. And ideally, you want them to be a table 4.
Okay. Why?
As the cost of insurance goes up, the way the IRS rule is written and the way you determine MECing, as the cost of insurance on the whole life and the term goes up, the cost and the amount of PUA bank goes up. So if I spend so there's a case that I just did, $1,500 a month. The woman was preferred, except the fact that she's got a shoulder injury that's never healed and she's got to have more operations. They put her down at table 4. So what happened was she lost $200,000 of insurance because the cost of insurance went up. Okay. But what also happened is because the cost of insurance went up, that means that term rider, which is more expensive now, offers more room for the PUA bank to grow. So we went from, she lost $200,000 of total insurance, but gained $50,000 of PUA bank capacity. If you're not doing it for death benefit, then the insurance person, the person that's insured, is should be the least healthy of the group.
What about if you got a couple in their 60s, one's 69, the other 61? You'd still go with the older one?
Doesn't matter. If I'm not doing it for death benefit, I don't care about death benefit. If all I'm doing this for is bank and retirement, then I'm going to do what's best for the client, which is to have the largest potential bank capacity within reason. There's always a caveat. Okay. So within reason, what happens if I know that this family is now on a fixed income and they're never going to be able to overfund it? Well, that's when you have a different conversation.
Okay.
Right. So, for me, if they're young and, young being under 65 years old, I'm looking at whoever's the least healthy person in the family to insure. And then I'm doing a convertible term on the other person to start that second bank. So you said earlier, what if you have 5 years before you're going to need to do that second bank? Do it now. Start the term now while the person's healthy before there's a problem, before they can't get approved.
So if MTL is off the table, do you know if Lafayette does one of those convertible terms?
I do not like Lafayette. Okay. I don't write a Lafayette.
I understand, but
too many problems with Lafayette.
In this case, Foresters and MTL are not available. So
you can ask. It's a phone call. They'll tell you.
Okay. I was just asking you. Okay. By the way, I understand your frustration. I've been having better experience with Lafayette lately. Just to let you know. Okay.
I ran 3 policies to them. The first one, it took them 6 months to give me a decline. They gave me a decline on December the 28th. The second,
I'm talking lately. I know there's been problems in the past.
They deposited money. The people withdrew the money. They sent it to the wrong account. It wasn't even in the same family. It wasn't in the same state.
Mm.
There's a list. I can go on.
Okay.
So no, I don't like Lafayette. I don't trust them.
Okay. Gotcha.
But you guys might go for it.
Well, options are limited in this case. So,
Okay. Harrison Zifkin, privately. We'll talk about that offline. MEC stands for Modified Endowment Contract, and that is what happens when you put too much cash into one of these programs. Anybody else? Got 7 minutes, or I get to go eat.
well, last thing I want to do is get between you and food.
No, I'm good. I got reserves. I got lots of reserves. I am not going to shrivel up and blow away.
I apologize for being late, Scott. I have a real basic question for you. I'm just getting started.
Missed the lecture, failed the quiz. That's how it works.
Yeah.
Hello, Winnie. Nice to see you.
Always good to see you. Always, always. So I'm just getting started with DFL, even though I was trained in, I don't know, it was like August or something. Just haven't been able to get around to it. I've been paying for it. So, you know, I got to pull it in.
You're spending money for the resources. You might as well use it.
And you know I will, and I plan to. So on the very fundamental level, learn that presentation, right? Send my first case over to the folks at DFL, and they'll send it to Foresters for me on a very basic level.
I can only speak from my experience. Okay?
Okay.
My experience is the first 3 cases I sent to DFL to do for me, all 3 of them did incorrectly, and it cost me a sale. Okay. So, you know, maybe your experience is different, and maybe it was my fault. Maybe I didn't give them enough information.
So you had the client to complete the form, and you had them, and that form you sent over to DFL, they structured it for you?
That's not how it works. You get the form back, you go into the system, you fill it out, and you request them electronically to do an illustration for you.
Right. Okay.
If I could kind of dovetail on what Scott said, your family bank did 2 of my first ones. I don't know whether they did them wrong or not, but I didn't learn a thing. When I learned something is when I spent an hour on the phone with someone at Foresters, and they showed me, okay, they know what we're trying to accomplish. You say, this is the amount of money that we have to work with. They don't care about the debts. They just say, this is the amount of money we have to work with, and this is what conceptually what I wanted to do. And man, they blew my mind. It took at least 2 hours on the phone with them. Happy to help. Happy to help. I'm sure MTL is the same way.
Absolutely, wow. They are.
So
that's nice and confusing.
Yeah.
Yeah. Your family bank
I would love to think that I'm Scott's favorite girl and he don't mind me bugging him.
Your family bank will not show you the carrier illustration and teach you how to use their illustration systems.
Yeah.
So for that, I would do what Tom said, or bug Scott. I prefer bugging Scott, but that's just me.
Yeah,
yes, you do, don't you? Twice today so far, right?
I just feel like I'm gonna bug Scott.
But when he try it with them first, because you also get to develop a relationship with them.
Okay.
And you know, I've had really good experience with Foresters. I haven't done enough business with Lafayette to have an opinion one way or the other. And Scott raves about MTL. But specifically the people at Foresters, I mean, they spent over an hour one time with me on the phone after hours. Because I called very late in the day.
Mm-hmm.
The guy was happy to stay on and say, you know, this is if you wanted to do this, you need to change this. If you wanted to do that, I mean, he explained how it works. And so.
Okay.
Here's some data about Foresters versus Lafayette versus Mutual Trust. Mutual Trust pays the highest commission. Lafayette pays 47% less commission than the Mutual Trust.
Yeah.
Foresters pays 53% less than Mutual Trust. Foresters has a required minimum whole life policy of $50,000. Foresters is the only one you can write a policy for 70 years old or older. Okay, so there's reasons why you have to go to Foresters. The only people I ever put with Foresters are all the older people, because that's where they have to be approved.
Who do you mostly
Mutual
use
Trust
that?
has a cap on the PUA of $100,000 a year. you can get an exception simply by asking for it. That's mutual trust. Foresters is 200,000. Lafayette is 300,000.
And you mostly, your go-to is mutual trust?
That's the only one I use if I can help it.
I'm going to do what
And
you do,
Winnie,
Scott.
you just went to DFL training this past August?
Me, yes. August, whenever it was, July, August, yes.
Okay. And the other thing is, if you write a certain amount of business with mutual trust
Yes.
within a year, they're going to give you up to $2,500. I don't remember how the other $1,500 works.
It's $1,000 for the first year, and it's $1,500 for the year after that. But the first year, up to $2,500 is available. You have to write and place, I think, 30,000 of business in your first year, and then they'll give you $2,500.
What,
And then
bonus?
I think it's not a bonus; it's an educational refund, because you're paying that money to DFL, to YFB every month. They'll refund you first year $2,500, second year, and every year after that up to $1,500 a year.
Wow.
But you have to write the business with them. It has to get placed. So realistically, if you're looking at, if you did the payment plan with YFB, $188 a month, they're going to pay about 80% of your cost for that software on an annual basis just by writing business with them.
I'm going to do that. Thank you.
All right, we're just about done. I got 1 minute. Anybody else?
I'll take the minute. Nobody's saying anything. Just to reiterate it, the presentation, it's easy to learn the presentation, but the presentation, then the client fills out that form so we can know what all their debt is. And then I do what?
Then you have to go into your YFB software, your DFL software. You have to log in. Then you have to go start putting in all the data. You have to transfer the data into that software.
Okay.
And then once you're putting in all the data, you're going to do, if you're sending this to YFB for them to do the illustrations for you, then all they're going to do is they're going to run an illustration with Foresters, whoever you tell them to run it with, pull the CSV file, put it into your DFL program, run a DMA for you, and that's the end.
Which you don't recommend.
Say again?
Which you don't recommend. You're saying I should reach directly out to Mutual Trust and work with them and let them explain to me how?
They're not going to explain to you how to use the DFL software. You need to learn that on your own.
Right.
And more importantly, you need to learn how to use the illustration software, because if you do it, like I still do good, better, best when I'm presenting to people, because there's a zero cost option, there's another zero cost option, and there's another zero cost option, depending on whether or not I'm grabbing people's 401ks or doing, reducing how much they're going to put in for whatever. There's lots of different places you can find money, but it can all be a zero cost option. So that's why good, better, best comes into play.
Thank you, Scott.
Yes, ma'am. All right, folks. Mr. Kuhn, nice to see you, sir. All right, folks, have a good night. McCrae will be back on that other link for anybody who wants to take the Medicare supplement training starting in 14 minutes.